Gold has been known as the ultimate safe investment. But did you know that between 1980 and 1999, gold lost more than 80% of its value after inflation? That's almost 2 decades of watching your money shrink. Yet central banks around the world are buying gold today at record levels. 1,000 tons in 2022 alone, the most in a half of the century. Why? Because despite the myths, gold still plays a crucial role in building wealth. In this video, I will break down 5 biggest misconceptions about gold investing and reveal what the data really shows. So by the end of this video, you will exactly know when gold makes sense and when it doesn't. Let's dive in. Myth number 1. Gold always goes up. So let's start with the biggest misconception that the gold only moves up. It doesn't. Gold moves in long cycles that can last decades. For example, in 1980s, gold hit $850, adjusted for inflation, that's over $3,000 today. But after that peak, it took 28 years to get back to this level. Imagine investing in 1980 and waiting almost 3 decades just to break even. And it wasn't the only time, because from 2011 to 2015, gold fell nearly 45%, which means that $10,000 investment shrank to $5,500 in just 4 years. Meanwhile, stocks were climbing to the new highs that even Warren Buffett, who famously avoids gold, joked that gold just sits there and stares at you. On the other side, when gold runs, it can really run. For example, from 2001 to 2011, it surged more than 500%. That's why serious investors treat gold like a cycle play, not a straight line. So gold can rise dramatically, but it can also stagnate for decades. That means that your strategy is more important than the metal itself. And that brings us to the second myth. Gold equals physical bars only. When people think of gold, they picture giant bars locked in a vault or laying on the table. But physical gold is only one way to invest, and often not the most practical. For example, gold ETFs like GLD hold over 50 billion in assets, making them one of the easiest ways to track the price of gold without storage hassles. On the other hand, mining stocks can deliver leveraged returns. For example, in 2019, gold rose 18%, while the Van Eck Gold Miners ETF surged more than 40%. But remember that mining companies aren't just tied to gold prices. They are still businesses with risks like poor management decisions, labor disputes, or debt problems. That means that gold mining stocks can actually fall even if the gold is going up. So while miners can amplify gains, they can also amplify the risks. My own approach to gold is part of the bigger system for evaluating investments. So if you would like to learn how I analyze companies, commodities, and build portfolios step by step, you can grab my ebook, link in the description, or you can scan this QR code if you are watching on TV. But many investors make the same mistake, assuming that the gold is completely risk-free, which brings us to the next myth. Gold never loses value. No asset is immune to risk, not even gold. So during the 2008 financial crisis, gold lost more than 25% between March and October before bouncing back. Between 2012 and 2015, gold had 3 straight years of losses, the longest losing streak in decades. Gold's price depends heavily on the real interest rates and the strength of the US dollar. So when interest rates rise, investors often move into bonds or cash, which can drag gold lower. So gold is not a guarantee, it's a hedge. And sometimes that hedge can take years to pay off. But does it mean that gold is useless when the stock market is booming? Not exactly. Myth number 4. Gold has no role in a bull market. Many investors think that gold only shines when stocks crash. but history shows that gold can perform surprisingly well even during bull markets. For example, from 2009 to 2012, while stocks were exploding higher after the financial crisis, gold climbed more than 40%. In the late 1970s, gold nearly tripled. Why? Because even in bull markets, risks like inflation and currency volatility never fully disappear. In fact, a 30-year study from World Gold Council found that gold delivered positive annual returns in over half of the US bull markets since 1971. This makes gold a powerful diversifier. It may not always beat stocks, but it can balance the risk. Even central banks understand this. That's why they bought record amounts of gold in 2022, despite stocks rallying the year before. One of the main drivers, of course, were rising geopolitical tensions, especially the war in Ukraine. When the global uncertainty spikes, gold demand tends to surge as countries and investors look for protection outside of traditional markets. And the part that most people miss is you don't have to be wealthy to build that kind of safety net. Myth number 5. Gold is only for the rich. Once upon a time, owning gold meant vaults, safes, and serious money. Today, it's open to everyone. For example, gold ETFs let you start with just few dollars. Fractional coins and gram-sized bars make it possible for everyday investors to build positions over time. In fact, some platforms even allow you to buy digital gold backed by the real reserves for just $1. Small steady moves can add up fast. For example, just $50 of gold a month since 2010 would have grown into thousands today. And you wouldn't need a vault in your basement to hold it. This isn't new, of course. For example, in India, families have built a generational wealth by buying tiny amounts of gold every year. Over decades, these small purchases have turned into substantial stores of wealth. And the same principle works anywhere today, with modern tools like ETFs and fractional investing. And remember, you are not just investing alongside individuals. Central banks, wealth funds, and even tech companies that use gold in electronics are all part of the global demand. That means that gold is one of the most liquid and accessible assets in the world, regardless of whether you are investing $50 or $50 million. So if gold isn't a guaranteed winner, isn't only for billionaires, and it's not risk-free, the real question is not whether you should own it, but it's how much belongs in your portfolio. And if you enjoyed breaking down these gold myths, you will love this video as well.